Sydney prices dropped 1.9% in the September quarter. What next for the Sydney market? Hi, I'm Nero from Investment Rise, and if you've been reading the stats, you know that the Sydney housing market dropped in value for the first time in 2 years by 1.9%, or on average about $23,000. So the question then is this the end of the property boom? Are we about to begin a downward trend? Are we about to crash? Well, remember, we've seen this before. Just 2 years ago, in 2015, the house prices dropped as well. But then they surged by about $100,000 or more on average. Why? Well, the Reserve Bank of Australia gave us 2 surprise rate drops, essentially to cushion the fall in the Sydney and Melbourne markets. But now, the RBA is singing a very different tune. They've indicated that their next move will be up in terms of interest rate movements. So if interest rate movements are not going to drop, and I truly believe that's the only thing that will keep the Sydney market and Melbourne market rising strongly in terms of price movements, what does that mean for the market? Well, I don't believe we're going to see a crash. Now, mind you, there will be people who say, 3-4% drop in prices is a crash. I personally don't believe that even if Sydney prices drop in value by 20%, that's not a crash. Now, that might sound strange. 20% seems huge, but just think about it for a moment. If Sydney prices drop 20%, that takes us back to where property prices were in about 2015 or so. I don't know about you, but I don't remember thinking that Sydney prices or Melbourne prices were cheap in 2015. So it's just that we've had such a huge boom in prices that there will be some sort of drop, I'm sure, but it's not really going to be a crash. Remember as well that these markets are, our 2 biggest cities are cities where the population is growing quite considerably. So eventually these markets will rise again. I'm reading reports right now that there are many big developers who are looking to land bank. They're buying up either office blocks or large blocks of land and holding them. Obviously, a lot of these are Chinese-backed investors. Whether fortunate or unfortunate, it's a different matter. But the Chinese-backed investors, they're land banking, waiting to release these new projects when the next boom cycle begins. So with the boom cycle essentially over now in Sydney, I think that much is definitely clear. The only report I've read talked about Sydney prices rising by maybe 4 to 8% over the next 12 to 18 months, but as long as interest rates don't rise. Well, that would be like saying, don't go out in the rain without an umbrella. Oh, you won't get wet unless it's raining. Then you look outside and it's raining. The RBA has said they're going to increase interest rates. So I don't see Sydney prices rising very much on the whole. So if you're looking to start your investing career, what does that mean? What does it mean if you want to get into the market, buy maybe your first or second investment property? You need to start looking at the next markets to grow, markets where the population is growing, where the rental yield is strong so your cash flow isn't badly impacted when rates rise. And stick to capital cities because that's essentially where our population is growing the most. And again, also stick to houses. It's an advice I've been saying now for a while. Stick to houses, capital cities, look at the rental yields, ensure that it's sufficient so your cash flow isn't impacted. But really right now, if you're looking to make money from capital growth over the next 3 to 5 years, I think the Sydney and Melbourne markets are probably markets you want to stay away from. The stats are out there. Whether prices will really drop even 20%, I'm not sure yet. But one thing's for sure, the boom markets of getting 15-20% growth per annum as we had for the last few years, that's gone in Sydney, and it's now time to think differently. Let me know what you think in the comments field below. Bye for now.